If you're a trader, you've definitely seen this happen before. Price rips through a level, takes out a high or low, and then snaps the other way. Traders get stopped out, breakout traders get trapped, and the real move takes off without them. Most traders shrug it off as a fake out, but that's a lie the market tells to hide what really happened. These aren't accidents, they're liquidity grabs, and once you learn to spot them, you'll understand why the sharpest reversals almost always begin right here. The problem? Liquidity grabs are hard to identify in real time. You only realize it after the candle closes and the move is already gone. But what if there was a way to see them the moment they formed? What if the chart itself could tell you instantly when liquidity just got grabbed? That's exactly what you're about to see. In this video, you'll learn exactly what a liquidity grab is and why it's so powerful. You'll see the free indicator that marks them on your chart the instant they happen. And then we'll take it further and show you how those liquidity grabs can be used to find extremely profitable setups. Let's dive in. So what exactly is a liquidity grab? Think of it as the market's way of springing a trap. Price pushes through a key high or low, triggers stop losses, vacuums up orders, and then snaps right back inside the range. To most traders, it looks like a breakout, but it's really the market getting ready to run the other way. But before you can spot liquidity grabs, you need to understand what liquidity actually is. In trading, liquidity means clusters of orders sitting in the market, waiting to be triggered. That's why certain price levels act like magnets. They're full of pending buy or sell orders. There are two main types you need to know: buy-side liquidity and sell-side liquidity. Buy-side liquidity forms at highs such as the previous day's high, the previous week's high, or even swing levels. This is where short sellers typically place their stop losses and where breakout traders look for long entries. Sell-side liquidity forms at lows, like the previous day's low, previous week's low, or swing lows. This is where long traders place their stop losses and where breakout traders look for short entries. And this is where the trap gets set. A liquidity grab isn't just price hovering around a level, it happens in a single candle. Price runs above or below liquidity, leaves a long wick as orders get triggered, and then snaps back in the opposite direction. When it happens at buy-side liquidity, you'll see a candle wick spike through the high and then close back down. Shorts get stopped out, breakout buyers get trapped, and sellers step in hard. That's a bearish or buy-side liquidity grab. When it happens at sell-side liquidity, the candle wick drives under the low and then rejects back up. Longs get stopped out, breakout short sellers jump in, and buyers take control. That's a bullish or sell-side liquidity grab. This one candle pattern is the footprint you're looking for. It's different from a liquidity sweep, which can unfold over several candles. Liquidity grabs are sharper, and they show you exactly where the market flipped direction in an instant. Once you know to look for them, you'll start spotting these grabs everywhere, right at the highs and lows where most traders get caught on the wrong side. The problem is, spotting these grabs in real time is tricky. In hindsight, the wick looks obvious, but when the candle's forming, it's chaos. Was it just noise, or was it the liquidity grab that flipped the market? That's where most traders hesitate and miss the move. And that's exactly why we built an indicator to detect these grabs the second they happen and mark them automatically. And the best part is, it's completely free. To add it to your chart, just open up TradingView and head over to the Indicators tab. Then search for liquidity grabs and click on this one by Flux Charts. There'll also be a link in the description. Once you've got it loaded, here's what you'll see. Every time a liquidity grab forms, the indicator marks it with a bubble right on your chart. The size of that bubble isn't random. It scales based on the strength of the wick compared to the body of the candle. A small wick prints a small bubble. A huge rejection wick prints an oversized bubble. Instantly, you can tell if the grab was minor noise or a serious flush of orders. And that's the power of this tool. No more guessing. No more squinting at charts, wondering if that wick counts. The indicator does the work for you in real time the second the liquidity grab happens. But let's break it down, because this indicator isn't just printing bubbles at random. You've got full control over the logic that defines a liquidity grab. The first setting is pivot length. This tells the script how far back and forward to look when deciding what counts as a swing high or swing low for the buy side and sell side liquidity levels. If you increase the pivot length, the indicator will mark more significant levels. If you decrease it, you'll pick up smaller intraday swing levels. It's completely up to you how much detail you want to see. Next is the wick to body ratio. This is the threshold that decides if a candle's rejection is strong enough to count as a grab. By default, it's set to 0.5, meaning the wick has to be at least half the size of the candle body. If you raise this number, only dramatic grabs with huge wicks will print. Lower it and you'll catch the subtle ones. And if you don't want to watch charts all day, turn on alerts. You'll get notified the moment a liquidity grab forms. Now that you've seen the indicator, let's show you how to use these liquidity grabs to find insane trade entries. The key isn't just spotting liquidity grabs on your chart, it's knowing which ones actually matter. And that's where higher time frames come in. A liquidity grab on a 15-minute or 1-hour time frame often controls the market, while the lower time frame helps you find a good area to open a position. So the strategy is simple. Use higher time frame liquidity grabs for context, then drop down to a lower time frame to find your entry. To make that process easy, we'll use the price action toolkit indicator. It automatically plots liquidity grabs on up to 3 time frames at once on a single chart, so you'll never miss the bigger picture or waste time switching between time frames. And it doesn't stop there. It also plots multi-time frame order blocks with volumetric data, fair value gaps, inversion FVGs, breaker blocks, market structure, and much more. You can get instant access at fluxcharts.com. There's also a link in the description. The first step of this strategy is picking your higher time frame and your lower time frame. The higher time frame gives the bias. It's where the liquidity grab forms. Look for buys after a sell side liquidity grab or green bubble, and sells after a buy side liquidity grab or red bubble. After the liquidity grab, use the lower time frame to find your entry. We'll use the 1 hour and 4 hour time frames for our higher time frame bias and the 15-minute time frame for our lower time frame entries. The beauty of this strategy is that it adapts to any trading style. Scalpers can pair the 15-minute time frame with the 1 or 2-minute time frame. Day traders can use the 1 hour with the 5-minute time frame. Swing traders can lean on the 4 hour with the 15 or 30-minute time frames. The framework stays the same. A higher time frame liquidity grab gives us a directional bias, and the lower time frame finds the perfect entry. Now let's put this strategy to work with some real setups. We're on the 15-minute gold chart. In the indicator settings, liquidity grabs are toggled on with the 4 hour and 1 hour time frames enabled. Make sure to also toggle on breaker blocks. These are order blocks that get invalidated and flip from support to resistance, or resistance to support. First, a sell side liquidity grab is detected from the 4 hour chart, shown as a green bubble. That tells us buyers are stepping in on the higher time frame and gives us a bullish bias. Price reacts and pushes higher, leaving behind a bullish breaker block on the 15-minute chart. That's where we'll look for our entry. Once price pulls back into the breaker block, we'll use one more piece of confirmation to ensure we have a profitable setup. In the price action toolkit indicator settings, toggle on the premium and discount zones. If price isn't inside a discount area, don't open a trade. Since price is in a discount area, take the buy. Set a stop loss below the breaker block and target a 2 risk to reward trade. Now let's flip it and run through a bearish setup. Again, we're on the 15-minute gold chart with liquidity grabs toggled on for the 4 hour and 1 hour time frames. Breaker blocks are enabled as well. This time, a buy-side liquidity grab is detected from the 1 hour time frame and plotted on our chart as a red bubble. That tells us sellers are stepping in on the higher time frame and gives us a bearish bias. Price reacts and rejects lower, leaving behind a bearish breaker block on the 15-minute chart. But just like before, don't take the trade when price pulls back without confirmation. Toggle on the premium and discount zones. Since price is sitting in the premium area, the setup is valid. Take the sell and place a stop loss just above the breaker block and target a 2 risk to reward trade. Pretty simple, right? So let's recap the strategy. Start with a higher time frame liquidity grab. Green bubble for buys, red bubble for sells. That sets the bias. Then drop down to a lower time frame. Wait for price to leave behind a breaker block and confirm you're in a premium or discount before pulling the trigger. Stops go just beyond the breaker block, and targets aim for a clean 2 risk to reward trade. Simple, structured, and repeatable. And this is why liquidity grabs are so powerful. They aren't random wicks. They're footprints of where the market flips control. Pair them with structure and context, and you'll start catching entries most traders never see. Load the free indicator on TradingView right now. Experiment with the settings and watch how many major reversals line up perfectly with liquidity grabs. And if you want to take this further, the price action toolkit puts everything together with multi-time frame liquidity grabs, order blocks with volumetric data, fair value gaps, trend lines, breaker blocks, premium and discount zones, and much more. You can get it now at fluxcharts.com. There's also a link in the description. That's all for this video. If you found it helpful, drop a like and subscribe to the channel so you never miss our other indicator and strategy walkthroughs. If you've got an idea for a video or an indicator you'd like to see covered, leave it in the comments. Every comment gets read. Thanks for watching, and we'll catch you in the next one.